the world of investing, it can feel incredibly loud, right?
Oh, absolutely.
Just a constant barrage of headlines, hot tips, and frankly, a lot of emotional noise.
Yeah.
Trying to find those truly exceptional companies, the ones that don't just bump up a few percent, but can actually multiply your money many, many times over the real multi-baggers, feels less like investing and more like, I don't know, sifting through chaos.
And it's a challenge because the market's short-term focus, it just often drowns out the quiet signal of true fundamental quality.
Right.
Identifying something durable, something built to last and compound over decades, well, that requires a different kind of attention.
That's where Bjorn Fallon comes in. He's not just writing theory from an ivory tower.
No, he's been in the trenches.
He spent over 20 years deep in the investment world as an analyst, investor, and now CEO of Red Eye AB. His book, Quality First Investing, it's forged from that very real experience, including, as he shares, some hard-won lessons like avoiding margin and absolutely prioritizing quality businesses above all else.
And look, it's landed with some serious investors. People like Christopher Mayer and Gautam Baid have praised it, called it a treasure trove of practical insights, a comprehensive framework.
It's clearly hitting a nerve.
Definitely.
And the subtitle tells you exactly what you're getting. A checklist approach to finding and sitting tight in multi-baggers.
Right there. Actionable.
Right away. This isn't just philosophy. It's designed to be a practical tool, a field manual almost.
Yeah, and he's tackling some fundamental investor problems head on. He talks about the insidious allure of mediocrity.
Settling for average.
Settling for average businesses. Then there's the impatience of short-termism that leads to constant trading.
Yep.
The often kind of haphazard way investors search for those exceptional companies. And a big one. The failure to build the deep conviction you need to actually hold on to a great company when the market inevitably throws a storm at it.
So what's the core answer Fallon offers? The big idea that cuts through all this noise?
Well, the powerful solution, the central thesis, is that truly exceptional long-term investment success, those multi-baggers, comes from a disciplined, systematic process.
Okay.
It starts by rigorously identifying high-quality companies, specifically by deeply evaluating their people, business model, and financials using a structured checklist.
And here's the kicker.
And here's the key. Doing that rigorous work is precisely what builds the unwavering conviction you need to sit tight for the long haul.
Ah, right.
It replaces speculation and emotional reactions with a robust framework focused purely on understanding and valuing true business quality.
And that's what we're diving into today. Using the material we have, we're going to unpack this framework, look at its logic, see how it applies in the real world, and, explore where it might have its limitations.
Okay, let's dig in.
Every strong investment philosophy, it sits on a foundation of core beliefs, doesn't it?
Absolutely.
What are the unspoken assumptions you have to buy into for Fallon's quality first investing approach to truly make sense?
Okay, so you have to accept a couple of fundamental ideas about how the market works, or at least how it works eventually.
Right.
The first is the conviction that intrinsic business quality is something real, something identifiable.
Okay.
That it tends to persist over time, and that the market, in the long run, will recognize and reward it.
So it's not just luck or a fleeting trend.
Not at all. Quality in this sense isn't ephemeral. It's embedded in the company's DNA, its leadership, its competitive edge, its financial resilience. Fallon echoes Benjamin Graham here, the idea of the market being a weighing machine over time.
A weighing machine, right.
His quote is explicit. If the business does well, the stock eventually follows. Simple as that.
And he thinks the market is actually bad at pricing that quality in the short term.
He goes further than just bad. He thinks it's systematically underpriced.
Really?
Yeah, he writes, quality is systematically underpriced by markets over long time periods because most investors tend to discount delayed gratification too heavily.
Wow.
Think about that. He's saying there's an exploitable inefficiency rooted in human behavior. Our impatience, our focus on the immediate payoff. That impatience leads the majority to undervalue the slow, powerful compounding of intrinsic quality. If quality was always perfectly priced, well, this whole approach wouldn't really work, would it?
That's a powerful idea right there. Okay, what's the second core assumption?
The second assumption is a belief in the method.
The process itself.
Yeah, the idea that a systematic, checklist-driven approach isn't just helpful, it's genuinely superior, that it can actually help you overcome your own inherent investor biases and make better, more consistent decisions.
Like the checklist in an airplane cockpit.
Yeah,
or a surgical operating room.
precisely. That parallel to Atul Gawande's checklist manifesto is mentioned by reviewers, and it makes sense.
Yeah.
It's a belief that imposing structure on a complex, high-stakes activity reduces errors and improves outcomes. So it's about guiding yourself through the emotional and cognitive minefields that plague investors. Fear, chasing trends, confirmation bias.
All that stuff.
All that stuff. And the fact that Red Eye's own internal quality rating system, which is based on this checklist, has reportedly generated impressive returns. Well, that adds practical weight to this belief in the system itself.
It's a vote for discipline process over pure intuition.
Yeah, exactly.
All right, so if quality is the destination and a systematic process is the vehicle, what are the essential components, the core pillars of this system Felon has built? How does he actually operationalize finding this quality?
Okay, let's break down the actual logic, the operating system. There are three primary pillars you really need to focus on.
Pillar number one.
This is the absolute non-negotiable bedrock.
Well,
if you take away one thing about his analytical approach, it's this. The intrinsic quality of the business itself is the single most important determinant of long-term success.
okay.
And perhaps counterintuitively for some, he argues it's also your ultimate protection against risk.
Protection comes from the business, not just like diversification.
Yes, primarily. He's very direct. The protection against risk is primarily in the quality of the companies. After all, if the business does well, the stock eventually follows.
Simple but powerful.
It demands that you shift your mindset from being a stock speculator to being a deep business analyst. Think back to his own painful lessons. Don't buy stocks on margin and focus on buying quality businesses. It sounds simple, but it's profound.
It really is like building. You absolutely have to get the foundation right first.
Exactly. You obsess over that business foundation, its quality, before worrying about the daily fluctuations of the stock price, which is just the paint color on the walls, right?
Right.
A weak foundation, a poor quality business, is inherently unstable, regardless of the price you pay up front. This stands in direct contrast to, say, pure deep value approaches that might overlook fundamental flaws.
Or those story stocks.
Or chasing story stocks, based on narrative alone. It's called quality first. For a reason, it dictates the entire approach.
Okay, so if quality is the absolute must-have, how do you actually assess it systematically? That brings us to pillar two, I guess.
Pillar two is the systematic quality audit, and this is where the checklist really comes into play.
Okay.
Fallon takes this abstract idea of quality and breaks it down into tangible, repeatable steps centered around those three dimensions: people, business model, and financials. He even gives them these memorable sort of operative names.
Which are?
First, you apply the people purity test.
Purity. That sounds like a really high bar.
It is. It really is. It's about scrutinizing the people steering the ship. The core question is, are the people behind the business of high integrity, energy, and skill?
Integrity, energy, and skill.
All three. It's not just about their resume. It's a deeper dive into their character, their drive, their long-term vision. Why is this so critical? Because management makes the capital allocation decisions, sets the strategy, navigates crises.
They can make or break it.
Absolutely. Flawed leadership can wreck even a fundamentally good business. This test forces you past those surface-level impressions.
Okay, people purity test. What's the second step in this audit?
Second, you conduct the Moat durability check.
Ah, the moat. That feels very Buffett-esque.
It absolutely draws on that concept, but with the crucial emphasis on its endurance, its sustainability.
Okay.
The question you're asking is the business model and competitive position such that the business is likely to stay ahead over the long term? It's not enough to have a moat today.
Is it getting wider or shrinking?
Exactly. Is it static, widening, or is it subtly shrinking? This check is a countermeasure against the tendency to just assume today's success will automatically continue without really examining the competitive landscape and potential disruptions down the road.
Makes perfect sense. And the financials, where do they fit in?
That's the financial footprint analysis. Here you ask, do the quality aspects show up in the financials right now, or are they likely to appear in the future?
So looking for the evidence.
Exactly. The idea is that true quality leaves a discernible trace in the numbers. Robust margins, efficient use of capital, strong and resilient cash flow, a solid balance sheet. Or you might find leading indicators that suggest quality is emerging but hasn't fully hit the P&L yet.
So the financials aren't the starting point necessarily, but they validate or provide evidence for the qualitative stuff you found.
Precisely. It grounds your qualitative analysis in quantitative reality. It's a countermeasure against falling in love with a great story that doesn't actually have the numbers to support it.
Right.
And it also helps you spot opportunities where underlying quality is building, but might not be fully reflected in lagging financial metrics yet.
And packaging all this into a checklist. Why is that structure so important?
Because investing is inherently complex.
Yeah.
Right? And our brains are wired with biases that constantly try to trip us up. The checklist forces systematic rigor. It ensures you don't skip vital steps, makes the process repeatable, and introduces discipline. As Fallon puts it, it helps you focus on the big picture while ensuring that nothing is missed. It's about building a reliable process to make better decisions consistently.
So you've done the deep work, applied the checklist to people, business, and financials. You really understand the business. That brings us to the third pillar, which is arguably the hardest part for many investors, actually holding on.
Exactly. Pillar 3 is forging conviction, and it's the psychological armor you absolutely need.
Yeah.
Knowing what makes a good investment is one thing. Having the mental fortitude to hold it through the inevitable market gyrations is something else entirely.
And this is where so many investors, jump ship way too soon.
Absolutely. Fallon's core insight here is that this deep, unshakable conviction isn't just willed into existence. It's not just positive thinking. It's earned through the rigorous, checklist-driven research you did in Pillar 2. Your conviction is a direct result of your deep, genuine understanding of the business. That understanding is your primary defense against market volatility and emotional mistakes.
So the analytical process itself is designed not just to find the quality, but to build the psychological strength to keep it.
Precisely. The system is explicitly built to help you build conviction to hold on to make mammoth gains. This isn't blind faith in the stock price going up. It's conviction in the underlying business that you know inside and out, because you've done the in-depth, on-the-ground research that the checklist demands.
Which directly addresses that key mistake he mentioned, selling winners too early.
It does. Fallon observes, when investing in high-quality growth stocks, the biggest mistakes are likely to be decisions to sell too soon. One of the most powerful concepts in portfolio management is to let your winners run.
Yeah.
When you truly know the business quality, you're far less likely to panic sell during a temporary price dip or market correction.
It reminds me of that ship captain analogy. If you've personally inspected every plank and sail of your vessel and know it's seaworthy, you have confidence when a storm hits.
Perfect analogy.
If you just bought it based on a hot tip and have no idea about its condition, you're going to be terrified at the first big wave.
That's it, exactly.
Oh.
Your confidence comes from that deep personal inspection, that deep work. And the book apparently shares some of Fallon's own investment suffering and how this framework helped him build that emotional resilience.
Right.
He even touches on dealing with overconfidence, suggesting this system provides a check against that bias too.
Right.
So the psychological strength isn't like a separate ingredient you add. It's an intrinsic outcome of the analytical rigor.
Okay, we've deconstructed the philosophy, the core beliefs, the 3 pillars, the psychological armor it builds. But any framework needs to be stress tested, right?
Absolutely.
How does this apply when you look at a complex, very modern company, and where might this approach, show its limits?
Okay, let's take a real-world example, a company that's often discussed, ASML.
Ah, the semiconductor equipment giant.
Exactly. The Dutch company that essentially holds a monopoly on the most advanced lithography machines needed to manufacture the cutting-edge chips in, well, everything these days. Dominant position, fascinating business.
So how would we put ASML through Fallon's people, business, financials checklist, quickly?
Okay, starting with the people purity test, we look at the leadership. CEO Christophe Fouquet, he has a long tenure at ASML, moved up through technical and leadership roles.
Yep.
That suggests deep operational expertise.
Okay.
CFO Roger Dassin also has a strong, relevant background. You'd be asking about their integrity, their long-term vision, their ability to navigate incredibly complex technological and, frankly, geopolitical landscapes.
Yeah, that's huge for them.
Their track record in managing ASML's growth and technological dominance provides pretty strong evidence of that skill and, energy.
All right, management seems solid on the surface at least. What about the business itself, the moat?
This is where it gets really interesting for ASML, isn't it? Their business model is incredibly powerful, selling those multi-million-dollar EUV machines,
The main products.
but also generating significant recurring revenue from servicing and upgrading them. It's a classic razor blade, but on a massive scale.
Right.
When you do the Moat durability check here, their competitive position is defined by just unparalleled technological superiority, particularly in EUV.
Nobody else can really do it at that level.
Pretty much. The R&D investment needed to even attempt to compete is astronomical, creating these immense barriers to entry. Plus, the underlying demand from global digitalization, AI, cloud, 5G, self-driving cars provides extremely powerful and crucially durable tailwinds.
So the moat looks exceptionally wide.
And based on their continued R&D lead, arguably still widening. That's the durability part.
Got it. And finally, the financial footprint analysis for ASML.
Well, ASML's financials absolutely reflect a company at the top of its game. You'll see strong revenue growth, of course. The PE ratio is often high, sometimes well into the 30s.
Yeah, it looks expensive sometimes.
It does, and that reflects market expectations.
Mm-hmm.
But the financial footprint analysis looks past just the headline multiples. You see incredibly high return on equity, often in the 50-60% range.
Wow.
Indicating extraordinary profitability and really efficient capital use. Gross margins are very strong, typically above 50%. Debt levels are moderate for a company of its size, and free cash flow generation is usually robust.
So the Fallon framework helps you analyze why a company like ASML, despite maybe a high sticker price, might genuinely be a high-quality business worth considering.
Exactly. It forces you to go beyond the price tag and analyze the engine underneath. Is that high valuation justified by extraordinary, durable quality and a unique market position? The framework helps you dissect that, distinguishing a truly exceptional business from something that's just riding a wave of hype.
That's a great way to see how it works in practice. Now let's be critical, as we should. Where does this model bend or perhaps show its limitations? No approach is perfect for every single situation.
That's a really important point. One potential limitation is what's sometimes called the quality trap.
The quality trap.
Yeah, it's the risk of identifying a genuinely high-quality business, but paying a price so high that your future returns are muted or even negative, despite the business continuing to do well operationally.
So the price you pay still matters, even for the best quality.
It absolutely does. Now, Fallon is aware of this. He discusses things like overpaying and margin of safety in interviews and other contexts.
Okay.
But the book's primary emphasis is really on identifying the quality first and foremost. Other strategies, like GURP growth at a reasonable price, explicitly try to balance both quality and valuation within their core philosophy.
Right. For
a strict quality-first adherent, the constant challenge is determining exactly what constitutes too much, even for outstanding quality. It's a judgment call.
What about applying this for the listener? The average retail investor. Can they really do this level of digging?
That's another valid point. The ideal implementation of Fallon's full checklist, particularly aspects like, say, attempting to interview management or deep industry experts, that can be quite demanding.
Yeah, probably impractical for most.
Potentially too thorough or impractical for the average individual investor, especially when looking at large global companies. The principles are sound and universally applicable, but executing every single granular step might require resources usually only available institutionally.
So the key for a retail investor might be to internalize the mindset and apply the principles rigorously to what they can thoroughly research. Public filings, calls.
Precisely. You apply the spirit of the checklist and its systematic rigor using the publicly available information you can access: financial reports, investor calls, industry news, competitive analysis. You do the best you can with what you have.
And how does this quality-focused approach tend to perform in different market environments? Does it always win?
Well, quality investing is often characterized by lower volatility. It tends to offer better downside protection during market downturns or periods of stress.
That's a big plus.
That's a significant strength. However, in really speculative bull markets or sharp recoveries driven by high beta, perhaps lower quality stocks, well, securities with higher risk and volatility can outperform quality stocks in the short term.
So it's not necessarily designed to be the top performer every single year.
No, it's generally more suited to those with long-term investment goals, which aligns perfectly with Fallon's emphasis on holding through cycles.
Right.
It's fundamentally a marathon strategy, not a sprint strategy focused on capturing every short-term market swing.
And finally, quality itself. Assessing things like management integrity or how durable a moat really is, that can feel a bit subjective, can it?
It does involve judgment, absolutely. And the definition of what constitutes enduring quality isn't static,
Things change.
Business models and competitive advantages can erode rapidly with technological disruption. We've seen many times throughout history, think Kodak or Blockbuster.
Classic examples.
While the checklist introduces structure and definitely reduces subjectivity, it doesn't eliminate it entirely. It requires continuous learning, staying informed, and crucially, a willingness to reevaluate your judgments over time. You can't just check the box once and forget it.
So bringing it all together then, how do these pieces, the belief in quality, the systematic audit, the forging of conviction, how do they connect into a single sort of self-reinforcing system?
It really is a virtuous cycle when you think about it. The fundamental belief in the primacy of intrinsic business quality, that's pillar 1, creates the need for a rigorous, systematic process, pillar 2, the people, business, financials checklist, to actually identify and validate that quality in the messy real world.
Okay.
Then doing that deep, diligent analytical work is what builds the profound understanding needed to forge true conviction, pillar 3.
Right, the armor.
And that conviction, that psychological armor, is what allows you to hold those quality businesses through the inevitable market noise and volatility, allowing their intrinsic quality to compound value over the long term. It's not just an investment framework. It's arguably a process for making deeply informed, high-conviction decisions in many areas.
If you could distill all of this down, maybe steal just one core idea or mental tool from Bjorn Fallen's approach and make it a part of how you think, what would that be?
That's a good question. I think the single most valuable takeaway is internalizing the disciplined quality checklist mindset.
That sounds like more than just, literally pulling up a list every time.
Oh, much more. It's adopting an ingrained commitment, a habit almost, to systematically deconstruct any potential long-term decision, not just investments, into its core qualitative components. Before getting swayed by the price, the hype, the narrative, or just emotion, you forced yourself to methodically scrutinize the essential factors: the people involved, the fundamental structure or business model, and the underlying integrity and resilience, that financial footprint.
Asking the hard questions first.
Asking, have I truly deeply understood the quality here? And have I methodically checked all the absolutely critical factors without omission? Fallen's early working title for the book was apparently Investing with Intelligence, Avoiding Painful Investing Mistakes by Asking 114 Smart Questions.
114 questions?
Yeah. That really captures the spirit of this deeply ingrained questioning mindset.
And why is that specific mindset so powerful, do you think?
Well, because it's a direct countermeasure against the major pitfalls of decision-making, right? First, it actively combats your cognitive biases, overconfidence, confirmation bias. It forces you to pause, structure your thinking, challenge your initial assumption.
Slows you down.
Exactly. Second, it builds genuine, deep understanding. It moves you beyond superficial impressions to the granular details, which is the only source of sustainable conviction needed to truly sit tight when things get rough.
Yeah.
Third, it makes your decision process repeatable and allows for learning. You have a consistent framework to analyze both successes and failures afterwards. And critically, it keeps your focus squarely on what matters most for long-term outcomes. The intrinsic fundamentals, not all the distracting short-term noise.
So it's really about making that structured, quality-focused, evidence-based inquiry your default approach to consequential decisions.
That's it. Perfectly.
Yeah.
It's a tool for avoiding those unforced errors and consistently orienting yourself towards building durable, lasting value, really, in whatever area you apply it.
And that wraps up our deep dive into Bjorn Fallen's quality-first investing. It really serves as a powerful and I think timely reminder that in the often chaotic pursuit of enduring value, a disciplined, systematic focus on intrinsic quality, supported by the deep understanding and conviction that rigorous work creates, offers a formidable and ultimately very rewarding path.
Absolutely. And maybe something for you to consider. Beyond investing, where in your own life or work could applying a disciplined checklist mindset to qualitative factors, thinking systematically about the people, the fundamental structure, the integrity of the situation, where could that lead to better long-term outcomes?
Join us next time on The Deep Dive as we continue to explore the ideas that shape great strategies and help us make better decisions.